Hello and welcome. In this presentation, we will explore current tax credit possibilities for your childcare business and how you can find out more to apply. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. As an individual and a small business owner, you are familiar with the tax system. As a childcare business, you understand the necessity to maximize every dollar to put back into your program to improve the lives of children, your staff, and yourself so that you can continue to provide services that your community depends on. You may have business goals such as offering staff benefits or performing home improvements to boost your program's quality, but it may seem to you that these items are too expensive to be within your reach. In fact, there are tax credits that you can use as you implement certain benefits and improvements within your childcare business. Tax credits are a useful tax savings tool as they offer dollar-for-dollar reductions in your tax liability. In today's conversation, we will discuss key tax credits that benefit small businesses, specifically childcare businesses, including pandemic-related tax credits for offering staff benefits, tax credit for hiring staff that belong to a targeted group, tax credits for employer-provided childcare facilities and services, and tax credits for homeowners, which family childcares can benefit from. We will begin with pandemic-related tax credits. The federal government offered tax credits for businesses who were impacted by the COVID-19 pandemic. The coverable period for the credits began March 13, 2020, and businesses can still claim them retroactively through 2024. The ERTC allows eligible businesses that were impacted by the pandemic, who continued to pay their W-2 employees, to receive a credit of 50% in 2020 and 70% in 2021 for wages paid out to staff. The maximum credit for 2020 is $5,000 per employee and $21,000 per employee in 2021. This was a significant tax credit for businesses and remains so. The FFCRA allows sole proprietors and businesses with employees to receive reimbursement for paid sick leave that was offered to staff who were out for pandemic-related reasons. This also covers program closures due to COVID-19 exposures. Businesses can receive reimbursement for up to 40 hours of paid sick leave per person from March 13, 2020 through March 31, 2021, and up to 40 hours per person for April 1, 2021 through September 30, 2021. Next, we'll review tax credits that you can claim for offering certain staff benefits. Learning about these credits can help make your goal to offer these benefits a reality. Small businesses can benefit from the Small Business Healthcare Tax Credit that will reimburse you for half of your contributions toward your employees' premiums as long as you cover at least 50% or more per employee. There are other guidelines that you must meet, which in most cases, a typical small to mid-sized childcare business would. For example, if an employee's monthly premium is $235 and you pay 50%, or $117.50, you would be eligible for a tax credit of $58.75. That translates to annual costs of $1,410 for you, and you would receive back $705 when you file your return. For more information, visit the Small Business Health Options Program, or SHOP, website. There you can search for an example of starting costs for healthcare insurance plans based on your location. Pro tip: maximize your savings by claiming the Small Business Healthcare Tax Credit and deducting your expenses for staff benefits. In the example shown here, Happy Apple Childcare has a SHOP health plan that their employees participate in. Happy Apple pays at least 50% of their employees' benefits, so they are eligible to receive the Small Business Healthcare Tax Credit. Their costs total $2,500. They can receive a tax credit for half of their costs, $1,250. Additionally, they can deduct as a business expense the full costs of the staff benefit they provide, which is $2,500. Small businesses that start up a retirement plan can benefit from the Setting Every Community Up for Retirement Enhancement, or SECURE, Act tax credit. Eligible employers may be able to claim a tax credit of up to $500 to $5,000 for 3 years towards setup and administrative fees associated with starting a SEP, simple IRA, or 401k plan. Additionally, small businesses can earn another $500 tax credit by adding an automatic enrollment feature to a new or existing plan. Learn more by visiting the IRS website and be sure to talk with your tax professional about this tax credit opportunity. Pro tip: maximize your savings by claiming the SECURE tax credit and deducting your expenses for staff benefits. In the example shown here, Happy Apple Child Care has a 401k plan that their employees participate in. Happy Apple pays $2,000 in setup and administrative fees. It was determined that they are eligible to receive the SECURE tax credit for $500. They also pay into their employees' retirement plans, and those costs total $2,500. Because it is a business expense, they can still deduct the costs of the staff retirement benefit they provide, which is $2,500, but cannot include the setup fees for which they receive the credit. Employers may claim the employer credit for paid family and medical leave, which is equal to a percentage of wages they pay to qualifying employees while they're on family and medical leave. This credit is available through 2025. These are the qualified leaves: birth of an employee's child, and to care for the child; placement of a child with the employee for adoption or foster care; to care for the employee's spouse, child, or parent who has a serious health condition. A serious health condition that makes the employee unable to perform the functions of his or her position. Any qualifying situation due to an employee's spouse, child, or parent being on covered active duty, or having been notified of an impending call or order to covered active duty in the armed forces. And to care for a service member who is the employee's spouse, child, parent, or next of kin. The credit that the business receives is based on the percentage of wages that you pay the employee while on leave, ranging from 12.5% to 25%. Businesses can receive a tax credit for hiring staff that belong to specific targeted groups. Historically, those in the targeted groups have faced employment barriers, and by employing them, you're helping to alleviate those barriers and contribute toward their economic stability. This credit is only for new hires, and you must request and receive certification that the person belongs to a targeted group. To qualify for the credit, you must complete Form 8850 and ETA Form 9061 or ETA Form 9062, which is the request for certification. There is a portion for you to complete and for the employee to complete. After you both sign the form, you will send the forms to the Department of Workforce Development, either electronically or via mail, by the 28th day following the hiring. The credit ranges from $1,200 to $9,600, depending on the target group the employee belongs to. Displayed here you will find those that are considered targeted groups, which includes recipients of temporary assistance for needy families, Supplemental Nutrition Assistance Program, or Supplemental Security Income. It also includes those that have been unemployed long-term, veterans, and summer youth employees. Next, we will discuss tax credits for employer-provided childcare facilities and services. For 20 years, the federal government has offered a tax credit to encourage businesses to offer childcare benefits to their employees. The employer-provided childcare facilities and services credit allows businesses to receive a valuable tax credit of 25% of related childcare expenses and 10% of their resource and referral expenses, up to a total of $150,000. A business can provide childcare services in these 3 ways. 1. Providing on-site care for employees. 2. Contract with a child care program. Or 3. Contract for research and referral to help their employees locate childcare. Childcare businesses themselves can also benefit from this tax credit if 30% or more of the children enrolled in your program are dependents of your employees. The use of this credit does not mean that businesses are providing free or discounted childcare for their employees, but rather that they are making childcare available for their employees. However, it is encouraged that businesses help to offset childcare costs, as they are able to. Pro tip: the availability of this credit could be a useful marketing tool for childcare businesses that are seeking to grow their services. Share information about this credit with businesses that you would like to form a possible partnership with to offer care for their employees. It's a win-win. The business is able to offer child care for their employees, and you benefit from steady enrollment. Now we will go through some examples of how this credit works. In the first example shown here, the business is contracting with a licensed child care to provide child care services for their employees. The contract is for $50,000. In addition, they contract with a local CCRNR to connect employees to other options for child care. That contract is for $10,000. The tax credit on the contract with the child care provider would be for $12,500. The tax credit on the CCRNR contract would be another $1,000. In total, Gidgets and Gizmos can claim $13,500 as an annual tax credit. In this example, a business is contracting with a licensed childcare provider to offer on-site services at their office building. They can include the costs of renovating or building out the center, plus the costs of their contract with the child care provider. In our final example, there is a child center that is licensed for 50 children. 15 of those children are dependents of their employees. Since they meet the 30% enrollment requirement, they can claim the tax credit as an employer-provided child care. Let's say their total operating expenses for the year is $400,000, they can receive a tax credit on 25% of those costs, so $100,000. Happy Apple can choose whether or not to offer a discount to their staff, understanding that their business would be able to recoup those discounts via the credit they will receive for classifying as an employer-provided child care. The use of this credit can allow them to receive additional revenue, secure enrollments, offer a child care staff benefit, and attract and retain staff. Finally, we will review tax credits that could benefit home-based family child care providers specifically. To support clean energy, the Inflation Reduction Act will extend and expand tax credits for certain energy-related home improvements. This may include energy-efficient solar panels, HVAC systems, windows, doors, appliances, and more. Specifically, there is the Energy Efficient Home Improvement Credit, which will be equal to 30% of total energy-efficient improvement costs made throughout the year, up to a maximum credit of $1,200. And the Residential Clean Energy Credit, which will offer a 30% credit on the cost to install certain systems that use solar, wind, geothermal, biomass or fuel cell power to power your home, heat water, or regulate the temperature in your home. Updates are underway for this new tax law, so continue to check EPA's Energy Star for guidelines and updates. For more information, visit the Child Care Collaborative of Iowa website or email fmc@midsioux.org.